Today we're going to talk about the worst performing stock in the S&P 500 this year. And because this might not be some great news for some, I'm also going to be talking about another stock that has been doing very good the last couple months. But let's start with that worst performing stock. So it's never fun to hold a stock that is in the red, but investors of this stock have had quite the disappointment as they have held the worst performing stock in the S&P 500 this year as stated. Can you guess the stock? Surprisingly, it's not Boeing, it's not Intel. Well, let me just tell you, it's Walgreens. And as you can see here, Walgreens stock has plunged over 65% year to date. That is more than any other stock in the S&P 500. This is devastating to lose this amount of money and feel like you may never recover it and quite possibly keep losing more and more. Then we have this chart that depicts Walgreens on the very left side of the chart, which shows those stocks that have underperformed versus those on the right that have had amazing returns, such as Nvidia. So why has Walgreens done so poorly? Well, it's mainly due to the rise in online pharmacies, but it's also due to falling reimbursement rates for prescriptions and having giants like Amazon eat into their general retail sales. So that's the non-pharmacy part of Walgreens. Now, some shareholders are even suing the company, alleging that they breached their fiduciary duty by inflating Walgreens' performance projections. Now, I have not been into a Walgreens in a very long time, and I avoid it like the plague. But when I do go into a Walgreens, it always felt like a dying store. It just has a negative energy to it. So if I heard rosy projections from management, I would ask them, have you set foot in one of your own stores lately? It does not look like a company with rosy projections. So I can see why investors are fuming. To add to Walgreens' woes, recently, a couple years ago, they acquired a majority stake in VillageMD for $5 billion with a goal of turning its stores into primary care destinations. This did not turn out how they wanted, and in June, Walgreens announced it would be cutting its stake in VillageMD, which was on top of an already painful $5.8 billion write-down of its value earlier this year. Not only that, but Walgreens also announced it would be dramatically slimming down its store portfolio with as many as 1/4 of its 8,600 stores set to close. On top of all this, the company has billions of dollars of debt. Sorry guys, it just keeps getting worse and worse. I really do feel for you if you hold Walgreens. As of May 31st, Walgreens had $703 million of cash and cash equivalents on its balance sheet, but it had $8.9 billion of interest-bearing debt. Also, with a business like Walgreens, you have to include all the leases it holds. These leases are mainly agreements for stores, warehouses, office space, and distribution centers that it rents. Leases are not technically debt, but they behave a lot like debt. Once this is included, things take a turn for the worse, as the company reported having lease-adjusted net debt of $29.8 billion at the end of May. Add to that, this company deals with a lot of theft. I know here in my hometown of Albuquerque, I had to go to some Walgreens and I saw theft happening right in front of my eyes. It's a huge issue with Walgreens. So that's also something that they have to deal with, which is lost revenue. So time is not on this company's side. They are falling behind the competition. They are being riddled with debt, and it's a company in quicksand, basically. So can Walgreens turn this around? It's not looking pretty at this point. I think it's a dying business, and it may be a situation where you might want to consider selling, taking your loss, and moving on, because they can very well stay in free fall for years to come and never recover. So that's Walgreens, the worst performing stock in the S&P 500 this year. But now let's turn things to a positive. I want to talk about something good. A well-performing stock as of late, the last couple months specifically, thanks to the hopes of a rate cut, this stock has been performing well, and that's Vici. Full transparency, I own this stock and I have a very large stake in it. I will not go into the details of Vici and its business, as I have done plenty of videos on it, but if you are new to hearing about Vici, basically is an experiential REIT with properties mainly on the Vegas Strip. I'm betting big on Vegas by investing in Vici, and so far, year to date, it's only up 4%, but again, the last couple months, it's up 22.87% due to those rate cuts being a strong possibility. Now, Vici has gaming properties and golf courses and a bunch of other experiential properties, and recently it acquired properties that a company by the name of Bolero sits on. And as you can probably guess, it's a bowling center, but it offers more than just bowling. It offers an arcade, billiards, also a sports bar, and a lounge. And as the economy cools, certain entertainment options have been suffering, like Topgolf, for example. Last month, it reported its fourth straight quarter of sales declines, and just in July, US sales fell 11%. Not a pretty story. Now, Topgolf is an expensive option for entertainment, reaching over $150 during peak hours. Who has that kind of money? It's similar to Bolero in that it offers food plus entertainment, but at those prices, it's sending customers elsewhere. For example, Dave & Buster's reported recently that revenue is up 3%. And as for Bolero, who also reported recently, it shared that same-store sales were up 7%. Bolero also offers a summer subscription pass, my favorite type of revenue, subscriptions and fees, and that brought in over $6 million alone. So this tells me that consumers are now focusing on lower cost entertainment, and companies like Vici are making smart business moves to acquire properties that hold entertainment options that are in high demand regardless of economic conditions. This makes me a happy Vici shareholder, and it should for you as well if you hold this REIT. Now, if we look at my portfolio, not too long ago, earlier this year, I was below 20% in growth. Now my portfolio is up over 29% in the green, and I just want to focus on Vici. There it is, and it's up 15.63% for me in the green. Not only that, but I have a large allocation of this stock in my portfolio. It makes up 17.11% of my portfolio, and if you take a look across all my investments, it has the highest allocation out of anyone else. Why? Because I said this so many times to you guys on my channel, while interest rates were sky high and it was suppressing REITs, especially quality REITs, that was the time to accumulate shares, and that's what I did. I took advantage of that situation, and it is now paying off. So I'm very happy that I did that, and that's what you have to do. You have to look for those opportunities. So with that said, do subscribe for much more content coming up. Have a great day, and we'll see you soon.